Yeah, today I'll go through the key stocks in my coverage universe ahead of reporting season. I won't go through all of them, just given time constraints, but just the key ones. But in short, most of the companies that I do cover are defensive. They're high quality, so I don't expect too many surprises. But nonetheless, three companies that I do think that could potentially positively surprise are Amcor, Orora, and Acro. So here are the reporting dates for the companies that I cover. The key ones starting on the weeks on the 15th are Amcor, Orora, and PWH. Then there's the following week there's a few big ones in Endeavour, Coles, Woolies, and Wesfarmers all reporting that week. But I might just start with the packaging sector, Amcor and Orora. So I mentioned this last week, but I'll just go through it again really quickly. But I do think both companies have the ability to positively surprise at the upcoming results. With Amcor, management does have a very good track record of meeting or exceeding expectations. And the fact that they tightened guidance range towards the top end of the range at the third quarter result in May suggests to me that things are going well. And I suspect that they wouldn't have tightened the guidance range towards the top end if the actual run rate wasn't at least slightly ahead of that. So I do think that typically management is conservative. So I don't think that there's a chance that Amcor could beat expectations. With Orora, so if you look at the last three results, they have comfortably beaten market expectations. And on average, the beat at the EBIT line is around 7%. So we're forecasting 14% EBIT growth for FY22, which is aligned with consensus. But given Aurora's recent track record, and there is also ongoing positive momentum in the business, I do think that there's a chance that it could beat again. In terms of preference, both Amcor and Orora, they're pretty good, stable, defensive businesses. And, I do think that in this type of environment, I don't think you can go too wrong with either Amcor or Orora. I think they'll hold up well. However, if you look at the recent share price performance, Amcor has held up better than Orora, whereas Aurora's pulled back a little bit. Amcor is now trading on about 16.5 times PE with a yield of a bit over 3.5% versus Orora on about 15.5 times and a yield of about 5%. I still really like Amcor. I think it's a core long-term portfolio holding, but just given the relative underperformance of Orora and the slightly more attractive valuation and also the yield, I do think it is starting to look a little bit more interesting than Amcor around these levels. So onto the supermarkets, and I'm not expecting too many surprises from Woolies and Coles. Obviously, the key focus will be on food inflation. And if you look back at the third quarter, inflation was running at about 3%. But that's likely to accelerate in the fourth quarter to probably somewhere between maybe 5 and 6%, really due to pressure on suppliers. And we've all seen the cost increases, around commodities, logistics, and also labor costs. I expect supply chains to remain tight on the back of the labor shortages and also the floods. And I think the key will be how all this plays out from a margin perspective. I'm forecasting margins for both Woolies and Coles to pull back a little bit in the second half. But both companies, they do have cost out programs and they do have efficiency initiatives in order to mitigate some of those cost pressures. On valuation, Woolies is on about 26.5 times PE with a 2.7% yield. While Coles is on about 24 times with a 3.5% yield. As a sector, I really like the supermarket sector. It's obviously very defensive and it does have a consolidated industry structure. So it does give Woolies and Coles the opportunity to pass costs onto customers. I think the one key risk is competition, and if one of them becomes irrational and adopts a more aggressive pricing policy, and that will force the other one to follow. But from what I've seen so far, I think it is definitely a rational market, and I expect that to remain the case going forward. In terms of preference, I do slightly prefer Coles over Woolies at this stage, just mainly on valuation. But to be honest, I think you can't go too wrong with Woolies either in this type of environment. So Endeavour, so similar to the supermarkets, I do think that the result will be largely in line. So for the retail business, I'm expecting sales to pull back slightly, really on the back of the reopening of the economy and as people move from drinking at home to drinking out again. For hotels, I'm expecting earnings to continue to recover as restrictions ease. Although one thing to note is that the floods that did do some damage to a number of hotels, and so hence there will be some earnings loss and also some asset write-offs in that hotels business. Endeavour, it's currently trading on about 26.5 times PE with a yield of a bit over 2.5%, and that is near the most expensive that it's been since demerging from Woolies about 12 months ago. As a business, I really like it. Endeavour, it's got strong brands, really strong market share positions, and it has performed really well. The stock's up about 23% over the last 12 months versus the broader market, which is down about 8%. So given the run that it's had, I do think around these levels, it is starting to look a little bit toppy. So I do think just to be prudent, I just look at taking some off the table in Endeavour around these levels. And if it does fall back to say around $7 or below, I think it'll look a lot more interesting from a buy perspective. Wesfarmers. So Wesfarmers, I think the result will be largely in line as well. So obviously the key focus will be on Bunnings, given that Bunnings does make up over 60% of group EBIT. And obviously there's some concerns around higher interest rates, cost of living pressures and lower house prices, and the impact that could have on Bunnings. But I thought I'd include this chart here, which shows Bunnings earnings over a very long period of time since the mid-1990s or so. And you can see from the chart that Bunnings earnings have been very resilient over a very long period of time, and also through multiple property cycles. And one of the reasons for this is that Bunnings is continually expands its addressable market. So it's never standing still. It's always looking for new avenues of growth and new sectors to grow into. Kmart, Target and Officeworks, those businesses were all heavily impacted by lockdowns in New South Wales and Victoria in the first half. And it is likely that that tough environment is likely to continue in the second half due to higher costs and also supply chain disruptions. Whereas on the other hand, the industrials businesses, that result should be pretty good on the back of higher commodities prices. Wesfarmers, the share price has had a bit of a bounce over the past month or so. It's now trading on about 21.5 times PE with a yield of around 4%. I think given the quality of the portfolio, the management team, and it's got a healthy balance sheet, I still think the valuation around here looks attractive and definitely comfortable with the ad rating on Wesfarmers. Reliance, so another stock that I'm comfortable with buying down here. I'm not expecting too many surprises from the Reliance result, although the pullback in the share price over the past 6 months does suggest to me that and the low multiple does suggest that expectations going into the result aren't high. And I think if it does report a half decent result, I think there's a potential that of a share price re-rating. Key things to look out for will be underlying demand, which I expect will remain strong on the back of the backlog of work, and also price rises. So Reliance has flagged price rises in FY22 of around 10% in order to mitigate higher costs. And obviously copper prices have come down quite dramatically recently. So that will flow through as a tailwind for Reliance, probably towards the back end of the first half of FY23 and going into the second half of FY23. So the stock's trading on about 15.5 times PE with a yield of a bit over 3%. And to put that into context, historically, Reliance has traded at an average PE of around 21 times. So I do think it's definitely cheap. Totally understand concerns around housing, but around 2/3 of Reliance's revenue is exposed to the repairs and remodel market. So it is a lot less cyclical and more defensive than the new construction sector. And over the long term, it's still got a big run rate of growth opportunities from increased penetration of push connect fittings products in the US. So I'm comfortable with Reliance as well. And then really just quickly on a couple of small cap stocks. PWH, I think the result will be in line, and the key focus will be on emerging technologies, given that this will be the key driver of growth over the next 5 to 10 years. The stock has had a bit of a pullback over the past few months. It's trading on about 33 times or so. So, definitely not cheap, but I do think it is a very high quality business, and it is definitely a genuine growth company. You just got to pick your mark of when you want to get in, but definitely one to keep on the watch list. And then finally, Acro, another really good little company. And it's got exposure to long-term growth in civil infrastructure investment, especially on the East Coast. It's had 4 upgrades in the last 11 months. And given management are quite conservative, I do think that there's a chance that it could beat expectations at the result. It's currently trading on about 6.5 times PE with a yield of about 6%. So I still think it looks really good value around here. And then, so just to summarize, so my key buy picks are Wesfarmers, Reliance, and Acro. In the packaging space, I think Amcor and Orora have potential to beat expectations. But in the very near term, I do think Orora looks slightly more interesting than Amcor, just given recent share price performance. In the supermarkets, I think in this type of environment where you've got higher interest rates and obviously higher inflation, I think it is a really good sector to be in. Don't think you can go wrong with either Woolies or Coles, but just slightly have a preference for Coles, just on the back of valuation and a better yield. And then Endeavour, really good business, really like it longer term. And but in the short term, I think it is starting to look a little bit expensive. So I just take a little bit off the table on Endeavour, and then if it does pull back to say $7 or below, you can pick it up around then.